Allie, what are you saying? Why would you ever in a million years not put money in a 401k? Although it sounds like an oxymoron, there are a myriad of pitfalls that can happen by overfunding your 401k. What is she talking about? Are you kidding me? I was told my entire adult life that if you put money in your 401k, my company matches or doesn't match, at the end of it, I can take out money and live off it in retirement. Well, let's take this apart a little and figure out why that may or may not work for you. So one of the things that's been very common in the last 10 years are 401k plans that have been rolled over to IRAs or still exist in 401ks or 403bs or 457 or 401as or many plans in which people have $500,000, $1 million, $2 million, $3 million in their 401ks. Now, you may think, this is a really good problem to have, and this is me, and they've done an exceptional job. Well, another thing we've seen is people are underfunded in other types of accounts. So they'll have $1 million in their 401k, and they'll have $20,000 in savings. And the problem is every single time they take $1 out of that 401k, they're taxed on it. Let's say you have $1 million in your 401k, and you've got $20,000 sitting in your checking account. And you say, well, I need to take out $4,000 a month to survive, which is about 5% of your 401k balance. But let's just keep going forward with this example. So you take out $50,000, but you get taxed on it. But then something happens. You need a new roof. Your daughter gets married. Your son gets married. You have a medical issue, and you suddenly need $50,000. Well, now, instead of taking $50,000 out a year, you have to take out an extra $50,000, but you need that money after tax. In order to take that money after tax, you may have to take out $70,000 to $80,000, depending on the other sources of income that you have coming in. Well, if you take out $70,000 or $80,000 out of your 401k, and you still need $50,000 a year to live on, well, you see where this is going. You potentially may run out of money. If you had $50,000 sitting in an additional brokerage account or a savings account or a CD or any other investment, you'd be able to pull that money out tax-free, potentially, right? So what if that money was in a Roth? What if that money was in a savings account or a checking account or any type of account in which you don't have so much taxable liability that comes out? Additionally, taxable income from your 401k can move up based on how much money you take out of it. So the more money you take out of it, the more you're going to get penalized. If you've listened to other videos that I've done, I've told you how many times healthcare needs drive the need to pull out large amounts of money from your 401k. In many cases, people have to start taking out $10,000 a month just to supplement an additional $6,500 worth of care. If you do that, you're going to run out of money. So the key thing is to come in balanced. You don't want 95% of your money sitting in a qualified account. Just to define, qualified accounts are monies that are tax deferred and get taxed at the time that you take it out, at whatever short-term income is. So whatever your top dollar income tax bracket is, that's how you're going to be taxed. So how do you get around that? You have to come up with a systematic way to deflate the balloon. In this case, the balloon that we're deflating is potentially not putting as much money in your 401k. Maybe you put it in a Roth 401k. Maybe it's not worth it for you to put it in a 401k at all, and you put that money in savings or an investment. So many options. It depends on the individual. But what I can tell you is eventually what happens with these 401ks or IRAs or any of these tax deferred accounts is you're going to be forced to take required minimum distributions. Currently, the RMD age is 73 years old. In 2032, it's going to move up to 75 years old. Right now, for every $1 million that you have in a 401k, you're going to have to take out about $50,000. That will change, and that's thumbnailing it, but you'd have to take out about $50,000 a year. And then it's going to increase on an annualized basis. It's based on the calculation of your 12/31 balance of the year before you have to take out your distribution. So what does this mean? It means that you can't control the taxation. It means that you've got all this money that's being pushed out. Many people believe that because the required minimum distribution age got pushed to the age of 75, it's a better thing. It really isn't. And the reason it's not is because the government knows that the more money you have to take out, the higher the amount of taxes they can levy against you. So before, you may have been at the 22% tax bracket. Now you're at the 24. Maybe you are at the 24 tax bracket. It pushes you over to the 32% tax bracket. Just to multiply that out, it can be a substantial amount. So if you take out an additional $10,000, then you're paying an extra $800 in taxes at the higher rate. If you take it 100, it's even more. So when you look at this, you have to ask yourself, what are the long-term taxable implications of what I'm doing today, and how will it impact me tomorrow? The older you get, the less tax write-offs you have. Chances are you don't have the same large mortgage. Chances are that your kids are grown up. Chances are there are just really nothing you can do to write anything off. Chances are you won't be able to make as many write-offs. The Internal Revenue Service knows this. And they bank on the fact that you will blindly go in to these gigantic required minimum distributions and take out money. So it's a double-edged sword. Do you really want to spend your entire retirement life donating to the Internal Revenue Service? That's what you have to ask yourself. Do you want to pay an additional $8,000 a year on every $100,000 because you didn't think about what you should do earlier? There are ways in which you can balance your investments so you pay minimized taxes. There are ways in which you can balance your investments that you don't end up having the largest charity in your life being the Internal Revenue Service. But you have to take these steps today. In many cases, the people who are doing the largest amount of donations are those who have really large 401ks, in which they can't control the flow. Another thing that happens too is 401ks is people don't want to take money out of them because of the fact they don't want to pay all the taxes. So now you have $1.5 million in the IRA, and you want to take out $100,000, but you don't want to because you don't want to pay $40,000 with state and federal taxes. So you just leave it in there and you become trapped. Have you ever been to an aquarium and you look and you say, wow, look at all the fish, but you don't get wet. You can't put your finger in. You just look at it behind glass. That's what happens to people with their 401ks. It's like having money that you can never get to because the penalty for getting those funds is too high. No one wants to pay 40 cents on the dollar because people always forget about, for the people who live in states in which there's state taxes, no one ever wants to pay 40 cents in the dollar. I live in California. California has high state taxes. You're going to pay some. So as we discuss this, what are some of the options in which you can make sure that that doesn't happen to you? What would happen if with planning, instead of paying the IRS, you can put some of that money aside for your medical future? Instead of paying them an extra $20,000 a year, what if you save $20,000 a year and you can put that aside for medical care in the future? These are the discussions that need to be had. You need to be able to put this through software, look at what your retirement income stream is going to be in the future, and ultimately make the best decision for you. But without planning, you're not going to get there. So what are the options for you? The important thing is to sit down, look at the cold hard facts, and figure out, based on rates of growth, inflation, market volatility, based on rates of inflation, growth, and market volatility, what the best options for you are. Each individual is different. You cannot rely on your best friend, on your husband, on your boss, on your kids. Each individual person is like a fingerprint. And because you're individual, even if you're married, you're an individual. You have to plan and figure out what's the best for you and your family for the long term. The goal of financial planning, the goal of specifically retirement financial planning, is getting you to the end and making your own decisions as opposed to someone else making those decisions for you. Hi, my name is Allie McFarland. I'm a managing partner at Wealthfolio Advisors. I help people like this every single day. We do it with a plan, an income plan, a retirement plan, and ultimately reviewing all the things that potentially could go wrong so you can have a more successful retirement. Click on the link below or call the number on your screen, and I'll be happy to sit down with you and review what we can do to make your financial future more secure.